You did break the rules. You have a phrase of the day, not a word of the day. Your phrase of the day is double-edged fear. It's not a phrase I'm familiar with. What do you mean by this?
I mean that there's kind of fear still of missing out, I think, on the AI wave, on the growth that we're actually seeing in all of tech, and I think that is spreading out across other industries. But then I also think there is fear about what happens with China. We do have risk from this shutdown continuing in the government, and there are some things happening in the credit market that haven't been super reassuring, although they've been quite contained within kind of one sector and maybe a little bit more fraud driven than not. But I think, I tried to change my word at the last minute to help you, but I changed it to duplex, but I mean the same thing.
All right, so the concept stays the same. There's a lot of things out there to worry about, but at the same time, we have a lot of investors that have FOMO and want to be active in this market. I want to talk to you about earnings coming up. How important are earnings specifically from the big banks?
I think they're important because they're a read-through to the economy, and we're missing that data because we're not getting CPI, we're not getting jobs data. And the banks, especially a bank like JP Morgan that we heard from yesterday, they bank so many of the consumers out there that it's a helpful understanding of where the economy is in a vacuum, if you will.
Okay, so if the big banks are so important, why are you positioned in regional banks? We actually had our Hugh Son on yesterday. He pointed out just kind of the divergence between the regional banks and the big banks outperforming by double digits percentage-wise.
Yeah, it's mostly because the big banks have outperformed so much from a valuation perspective. I see a little just more potential upside in the regional banks, especially with deregulation and M&A. We saw Fifth Third Bank acquire Comerica. I don't think that's the last one you're going to see. And I just think there'll be a little bit more upside potential in the region, in the smaller bank space versus the big ones. Even though there were good earnings, yesterday, it's not like they had double-digit returns yesterday because the expectations are already there.
All right. Yesterday, we also heard from Jay Powell, who seemed to suggest that the central bank is going to reduce its bond holdings. You're actually increasing your bond holdings, specifically your exposure to longer duration. Why? Why right now?
It's a marginal change. We've been extremely short. We've been hanging out in T-bills for where we do have bond exposure and Robinhood strategies. And we just wanted to balance that a little bit more because we are a little later cycle. I don't think we're at the end of the cycle, but, just kind of risk management a little bit, because if we do actually have lower inflation despite tariffs, because maybe the job market is weaker and the read through from AI is that there's just more productivity and less inflation, that it makes sense to just be a little less short the entire time, entire allocation.
Let's get to your pick. And Stephanie, I want to ask you, are you concerned about valuation? Because your pick is a lower valuation AI play. Why don't you tell us what it is and why you think this is a good buy right now?
Yeah, it's a position we hold in Robinhood Strategies. All year we've been GARP oriented, or I shouldn't say all year, I should say since the middle of the year. Feels like all year. But GARP meaning growth at the right price. So looking for growth companies that still have decent valuations. And NetApp is one of those, ticker NTAP. So this stock is priced at 14.6 times, which is like a 30% discount to the S&P. And they do mostly like data storage and cloud storage. It's something that we're just looking for opportunities that may be just under the radar because so much has been focused on a couple of names in the AI space. And this to me is kind of part of the picks and shovels versus like kind of the main course. And that's why, we like it. We think that it's a little under the radar, especially because only 30% of analysts actually have a buy rating. So it's not like people are, really focused on it.